So, say now what is not so great about IRR? Number one, if I tell you that there are two projects, project A and B, IRR of project A is 20%, IRR of project B is 35%. Which one will you select? Okay, so they are mutually exclusive. You would select B?
No, it depends how much is the period and how much is investment required.
It depends, but it depends on what? IRR cannot be used in isolation. IRR of 35% does not necessarily mean that this is a higher than cost of capital. So when you want to decide IRR, you have to compare that with
Cost of capital.
cost of capital. And if I tell you that cost of capital for this project is 38% and cost of capital is 10%, we are actually going to select project A, not B. So which means number one, write down point. Okay. You say problems with IRR. Heading problems with IRR. See, IRR cannot be used in isolation. IRR cannot be used in isolation. It has to be compared with cost of capital. It has to be compared with cost of capital. Whereas if you saw NPV, the moment you saw it positive, you could accept the project. You can't do that with IRR. It has to be compared with cost of capital. Clear? Second, that IRR, there might be an issue which is called no IRR. Okay, IRR is basically a simple mathematical solving, a simple mathematical number that fits into equation. So at times there is a possibility that an equation might have no IRR, or at times there is a possibility that an equation will have multiple IRR. Okay, and this multiple IRR typically happens when the cash flows are unconventional. So yeah, unconventional means positive, negative, and the amount fluctuates very substantially. Then at times there would be two numbers which would satisfy the equation. Okay, so then write down below that we might have a no IRR or multiple IRR scenario. We might have a no IRR oblique multiple IRR scenario. Third biggest problem with IRR is IRR assumes reinvestment of cash flows at IRR. Write down third point. IRR assumes reinvestment of cash flows at IRR. Okay, what does it mean? The last point. Let's do an example. Let us say there is a project. This is time 0, this is time 1, this is time 2, this is time 3, this is time 4. Here you have invested 100, or let's say 1000. You will get 100 here, 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 you will get 1000. What should be the IRR of this problem? 10%. IRR is nothing but YTM, and the bond is trading at par value, which means YTM should be 10%, therefore IRR is 10%. Now, what is the meaning of this IRR? Now, if you look at this logically, see what's happening here. That what happens is that when I receive these 100 at the end of year 1, I reinvest them again. For how many years? 1, 2 and 3. Okay, so can you please solve 1.1 into 1.1 into 1.1 into 100. 1.1 cube.
3.1.
हाँ exact निकालो with all the decimals. 1
3.1.
133.1 into 100, which would be
No, into 100 is
133.1.
133.1.
So this 100 in 3 years will become 133.1. Correct? If I invest these 100 again for 2 years, they will become 121.
Yes.
So this would be 121. If I invest these 100 again for 1 year, they will become
100.
110. These 100 today anyways are
100.
100, plus what I also have is this value of 1000. So let's take a total of everything that we've received. 1461.1. So if I reinvest everything at the rate of 10%, then at the end of year 4, what I get is this amount. Okay, 1464.1, which means I invest 1000. Here I have invested 1000, and in 4 years they've become 1464. Calculate IRR. So calculate at what rate they have been compounded.
10%.
So it would be 1464.1 divided by 1000 under root twice. You'll have to take fourth root. So under root twice, it would be 1.1, which means the IRR here is 10%. But imagine now that what we assumed is that after year 1, I will get to reinvest cash flows at 10%. Not necessarily true. Is it? After year 1, I might get to reinvest at 12% or 13%. So if that is the case, my actual yield would be higher than IRR. But if I reinvest at a rate which is lesser than that, my actual yield would be lesser than IRR. So one of the biggest problem with IRR is that IRR assumes that interim cash flows would be reinvested at IRR again. Are we clear with this? So you might want to write down this example. Is it done? Quick. Are we good to move? Okay then. So we are okay with first two numbers. Just write down a small point below this. If we relax the assumption of reinvestment at IRR, if we relax the assumption of reinvestment at IRR and allow reinvestment to be done at different rates, and allow reinvestment to be done at different rates, the yield that we earn in that case, the yield that we earn in that case is called as modified duration. Sorry, modified IRR. The yield that we earn in that case is called modified IRR. Okay. Then the next concept is payback period. So let's do, yesterday we had done example 1. Let's do the second example now. Let's say there is a cash flow is in this fashion. This is time 0. 1, 2, 3, 4 and 5. Okay, you've invested minus 20 lakhs here. In year 1 you'd get 10 lakhs, then 4 lakhs, 8 lakhs, 6 lakhs and 5 lakhs. These are the cash flows of a project. Calculate payback period. So write down the question and try solving for payback period. In how many years you've recovered your entire amount? Payback period, not discounted payback. A payback period ignores time value of money. What you have to use is interpolation, linear interpolation. Hmm. 2 year 9 months. Anuja? See here, how do you calculate payback period? If I have to just give you the formula, the answer would be 2 plus 6 by 8. Okay, and that 2 plus 6 by 8 would become 2.75 years. And 2.75 years would mean 2 years and 9 months. Okay, but what is the logic here? See, in up to 2 years, total amount that you've collected is 14. What you need is another 6. In the third year, you've collected in total 8. So in 12 months, you've collected 8, but how much do you need? Only 6. So then, how many months for this period? So it would be 12 into 6 divided by 8, which would be 9 months. Which means the time when you actually collected your entire 20 would be 2 years and 9 months.
But sir, from second to third year, it's from 4 lakhs to 8 lakhs.
I haven't raised. Second year we collected 8. Third year we collect. second year we collected 4 in this period. It's not from 4 lakhs to 8 lakhs. In third year in total we've collected 8. These are not cumulative cash flow. Are we good to move? Have you written down the example? So write down below this. Have you written down the example? So write down below this. Disadvantage with PB is that it ignores time value of money. Okay. Have you by any chance ever read a website called pagalguy.com? No? Do you know what Pagal Guy is? सुना है किसी ने? नहीं सुना है पागल Guy? अच्छा, ठीक है, no problem. Basically, this is kind of an education portal. Okay, and very popular. It's extremely. Have you heard of Shiksha.com? TV पे आते हैं. हाँ, so similar. So in fact, Shiksha.com came in later. It was the Pagal Guy who kind of started that industry in India. So if you go to Pagal Guy, what it gives you is a payback period for a MBA in different colleges. A payback period in MBA for different colleges. For example, the college where I teach, they charge, let's say, a typical fees of about let's say about 14 lakhs over the period of 2 years. Okay, this fees includes their food, stay, accommodation, and those kids typically get paid about 8 to 9 lakhs after they pass out. Okay, which means approximately their payback period is about 1.5 to 1.7, 1.8 years. So that's how on that Pagal Guy website they have listed payback periods for different B schools MBA. Okay, so I happened to meet someone who represented the company, and then we had discussion about this, and I thought that this methodology is in a way incorrect. Okay, why? Because typically think of someone who goes to a B school, that first cost that they incur is that 14 lakhs is in the form of fees that they pay. Second, that generally if you would see the kind of people we used to get in our colleges, these were typically having about 2 years of experience. Okay, so 2 years of experience, let's say in IT, they would earn salary for about 6 lakhs. So for another 2 years when they're doing their full-time MBA, they don't get to earn that salary, which means there is an opportunity cost of 12 lakhs. Okay, so 14 lakhs plus 12 lakhs here, total costs come out to be 26. So total cost comes out to be 26. Now, so let's say that this is where a person starts MBA. Okay, this is where he finishes in 2 years. Now, this is where he starts his salary. Let's say the first salary comes out to be 8 lakhs to him. Okay. Now, if I divide this with 8, it would be incorrect. Because had he not taken opportunity cost, had he not done MBA, he was earning about 6. Let's assume appreciation of 10%. By the end of first year, he would have become 6.6. Appreciation of 10%, approximately he would have become, let's say, 7.2. So when he's getting salary of 8, anyways he would have got salary of 7.2. So the only incremental salary is 0.8. So the payback period should be 26 divided by 0.8. Calculate how much? Huh? 32.5 years. Followed? Of course. कहाँ का? 8 वाला भी इंक्रीज होगा, क्यों नहीं? हाँ, करेक्ट, यूर राइट. सो 8 वाला भी इंक्रीज होगा, 8.8 होगा, और ये 7.2 will also become sum. So there would be a growing annuity here. which means it would be less than 32.5. But of course, if you quote that a payback period of an MBA is 32.5 years, no one would really think of doing it in their dreams. Of course, this might be a little bit of exaggeration. If you, instead of 6, if you make this as 4, the payback period improves substantially. Not all the colleges will charge you 14. So if you make this as about 10, again it would improve. But in any case, it would be in the range of 10 to 12 years. CA का payback period कितना है?
प्रैक्टिस में जाओगे तो 10 से ज़्यादा एक्सपेंसिव।
CA, a lot of people feel CA is a very cheap course, okay, which used to be, I think, at one stage. So your costs increase exorbitantly because of the training that you people do now, classes, yes. Second, there is a very huge opportunity cost that's charged to you indirectly that people generally don't see that, which is the 3 years of input that you put in. Okay, that whatever stipend you paid, even if you work in a call center today, you would earn about 12,000 a month, right? So which means to do your articleship every month, you're paying about 10,000 rupees, which means cost per annum is about 1.2. So which means over the period of those 3 years, you've paid about 3.6 to 4 lakh rupees to your principal indirectly. So if you consider that cost, opportunity cost would still be high. Yeah, let's move on. So we've calculated payback period. Let's do the same example, or let's do slightly different one. Example 3 now. Discounted payback period. So this is 20 lakhs. 1, 2, 3, 4, 5, 8, 10, 12, 14 and 16. Calculate discounted payback period. Assume a discount rate of 10%.
Years, 6 months.
2 years and
6 months.
so exactly 2.5.
6.65.
6.65. 2 years and 6 months. Yes, anyone else? See, what you need to do is The question is more or less same as PB. The difference is, now here instead of 8 use 8 divided by 1.1, which would be how much?
7.2, I think.
7.27. Instead of 10 use 10 divided by 1.1 square.
8.26.
Then 12 divided by 1.1 cube.
अरे हाँ ये सब
9.01, so this is 15 sufficient, so we don't have to do subsequent ones. So 7.27 plus 8.26, so that's 15.53. Now 15.53. So 15.53 is what you've got in 2 years. Okay, 15.53. So how much do you need extra? So that's 4.47 as a ratio to how much you get in year 3, 9.01. And that's coming out to be how much? Two point 5.
5.95. 6. 5.95 months.
हाँ, so 2.59 years. नहीं 4.47 divided by 9.01 कितना आता है? 4.47 divided by 9.01.
0.49.
So that's 2.49 years, which means 2 years and about 6 months. Slightly less than 6 months. That's the discounted payback period. Follow the logic? Did you do it the same way earlier? ऐसे किया था ना?
15 लिया था मैंने, 15.53 नहीं लिया, इसकी वजह से।
सर 8 की वैल्यू दूसरे साल में 8.8 हो जाएगी।
Which 8?
पहले साल का 8 है,
हाँ
उसकी वैल्यू दूसरे साल में 8.8 होगी,
हाँ
तो 18.8 हो गया।
हाँ
और दोनों की मतलब 10 की और 8 की मिला के
तीसरे साल में कितना होगा?
तो उसका डिफरेंस कैलकुलेट करके इंटरपोलेशन नहीं कर सकते। फॉर एग्जांपल अगर आप देखें,
Because why you can do that? Because on today basis that 20 lakhs is gone today. So if you want to do interpolation, you also need to take
20 lakhs
all the cash flows have to be on same point scale. You can have one cash flow on this time 0 and other cash flows on different time. So when we have taken present values, all the cash flows are on time 0 basis, and then we are doing interpolation. Yes, any questions you would like to ask here? चलायचं पुढं? Okay. And the last one now is Profitability Index. Okay, which would be your example. What is the number now? 5 or 4? Example 4, Profitability Index. Again, this is a project. Okay, 0, 1, 2, 3, 4. You've invested 50 lakhs, 30 lakhs, 20 lakhs, 10 lakhs, 5 lakhs. These are the cash flows. Oh, it might turn out to be. ठीक है. Discount rate is 10%. Calculate profitability index. How do you calculate profitability index? Does anyone remember the formula?
Would be present value of cash inflows
Mhm.
divided by present value of
Correct. Present value of inflow divided by present value of outflow. And if NPV is positive, profitability index would be more than 0? More than 1. More than 1. because inflows would be higher, so numerator would be higher. So as long as NPV is positive, PI would be greater than 1. Otherwise it would be less than 1. Correct? So karo calculate. It's positive?
Yes.
Are you sure?
54.09 NPV.
Inflow 54.09 आ रहा है. 1 point
09.
So you don't have to write all the numbers, you can save them in your calculator. That will improve your accuracy and speed. Hmm? 54.72. Niranjan, you got it? So let's do it together in case if you're not getting it. First, clear off your memory. Say 30 divided by 1.1 m plus 20 divided by 1.1 equal to m plus 10 divided by 1.1 3 times equal to m plus 5 divided by 1.1 4 times equal to m plus. Memory recall. So that's your present value of inflows divided by 50. Are we okay here? Alright then, so on basic front we've done most of the part. Okay. So now there is a concept called NPV profile. Okay, so what typically firms do is, so you can give the heading, say NPV profile. NPV profile. Okay, so write down NPV profile will plot NPVs on the y-axis at different discount rates on x-axis. NPV profile would plot NPV on y-axis and different discount rates on x-axis. Okay, what is the idea with NPV profile? It's kind of a concept which is used very heavily in the practical corporate finance world. That you draw a graph like this, you put NPV here, okay, and you put your different cost of capital here. Why? So if you're a corporate finance team and you're evaluating a project, okay, what they will typically do is they will give you a cost of capital and they will ask you to draw NPV. But of course your cost of capital can vary, isn't it? You might get funding from bank at a higher rate or lower rate. So what you typically do for them is you draw them a profile like this. Okay. So what are you telling them? You're saying them that if the cost of capital is 0, this is my NPV, and this y-axis is nothing but this y-axis intercept is nothing but total of undiscounted cash flows. Total of undiscounted cash flows. So as the discount rate increases, your NPV decreases, which makes sense. This x-axis intercept is the point where your NPV is 0. So this point here, x-axis intercept, this is the IRR. Okay, that this is the rate at which your NPV would be 0, and if the rate goes further, NPV would be negative. This is called as NPV profile. Okay, so you can draw this and write down what is x-axis intercept, y-axis intercept. It would not be a straight line, it would be slightly curved, convex towards the origin.
Total of undiscounted cash
Flows.
nahi, cash
Both,
flow.
inflow and outflow both. The logic is if interest rate is 0, NPV is nothing but inflow minus outflow without taking time value of money.
Y-axis intercept total of
Undiscounted cash flows. It's a curve, it's not a straight line here. Are we good to move? Okay. Now, next concept is crossover rate. Okay. So, a crossover rate is the rate at which crossover rate is the rate at which NPV of two different projects will be same. NPV of two different projects will be same. Okay, so first depicted graphically, and then we will understand this with an example. So again, what I have here is NPV, what we have here is cost of capital. This is the NPV profile of the first project, and this is the NPV profile of the second project. So at some rate, those NPV would be same, and then this rate is called as crossover rate. Okay, so below this rate, one project will have higher NPV. Above this rate, one other project will have higher NPV. Okay, so first depicted graphically, and then we will solve an example so that you would understand this better. ठीक है. Now, how to calculate crossover rate? Okay, it's unlikely that you might have a direct question on this, but in case if it comes, you should know how to deal with it. The logic is that we want to find out that rate at which two NPVs would be same, correct? So let's do a project. So let's call this as example. What should be this number? 5. Okay, so example 5 here. Let's say we have project A and project B. This is time 0, this is time 1, this is time 2, this is time 3. Project A invested 1 lakh rupees. It gave us a cash flow of 50, 50 and 50. Project B invested in a cash flow in a project which invested 80,000 rupees, which gave us a cash flow of 40, 40 and 40. So what we want to do is we want to find out that rate at which the NPVs of both the projects would be same. Now why would NPVs of these projects be different? Because they have different cash flows. So if you find out what are the different cash flows, that in the project A I'm paying extra 20,000, but what I'm getting there is extra 10, 10, 10,000. So somehow if I could make these extra cash flows 0, then automatically NPV would become same. So I have to find out that rate at which minus 20k would be equal to present value of this 10,000. Okay, so these would be called as incremental cash flows here. And that rate at which these cash flows would be same as this would be the IRR of these cash flows. So once I calculate IRR, at that IRR, both the projects will have same NPV. Okay, so in this case what I'm going to do is I'm going to use Excel and give you the IRR, and then you can cross check by using that IRR to calculate NPV of A and B. Okay, so IRR of incremental cash flow, IRR of incremental cash flows, okay, that's given, is equal to, let me solve this. Minus 20 is what's going out today, and then we're getting 10 for each of the year. So your IRR will be 23.375%. Okay, so let's plot that 23.3 कितना था 75%. Let's calculate NPV of project A at 23.375% and calculate NPV of project B at 23.375%. Now in this case the cash flows is same, so calculation of NPV would be faster. Yes. Is it done? Do you want to do it together? करो साथ में. Let's calculate for the first one. First, recall clear of your memory. Then say 50 divided by 1.23375 equal to m plus equal to again m plus equal to again m plus. Memory recall. From which reduce 1 lakh. So 1 lakh means you should have reduced 100, which means it would become 0. Okay. So this is coming out to be 0 NPV. Let's check for the other one. Let's do the second one.
562 उतना चलेगा ना?
हाँ
562 आ रहा है.
NPV
62 रुपीस. हाँ
562 रुपीज आ रहा है. हाँ मतलब कुछ
23.375 थोड़ा राउंड अप किया ना.
So it's close to 0. Let's do the second one. Memory recall. Then say 40 divided by, make sure your memories are clear. 40 divided by 1.23375 equal to m plus equal to m plus equal to m plus. Memory recall. This is 80, so this is coming out to be 0. Which means in this case, your NPV profile, they are intersecting each other at this rate, which is the IRR rate, and then they are changing their course. I could have drawn it here. So this is the first NPV profile and this is the second NPV profile, and they are intersecting each other at IRR, and that's because we kind of tilted these cash flows. We kept them half of this. Follow the logic? Are we good to move? Okay. Now the next area we want to pick up is cost of capital. Okay. Now see, a company wants to start a business, it wants to raise money. The three typical sources from which it can raise money is equity, or it can raise money through a hybrid instrument, which is preference share, preferred stock, or it can raise money through debt. Now tell me, out of these three, which one is more expensive to the company? Equity comes free.
It has assumed
Less
expectations of equity shareholders is higher than debt,
Mm-hmm.
because they are bearing more risk and they could
But
have
risk
earned
is
that
the-
much of return by investing in debt securities, not in equity.
Okay.
So they-
Yes, he's right. That think from an investor perspective. If you, as an investor, you get to know that on debt, company gives 15. Then you would say, if I'm investing in preferred stock, I'm taking more risk, isn't it? Because I will be paid only if the company makes profit. So I want 20. But if I want to invest in equity, I'm taking all the more risk. So I would want higher, 25%. Which means from a company's point of view, equity would be most expensive, then preferred stock, and then debt. So let's say that if this is a structure and we want to calculate cost of entire capital to the company, then what should we do? We should take an average of these, and we said cost of capital to the company is 20.
weighted average.
No, we cannot, because we have to see what is the relative value of each of these. So what if company doesn't have preferred stock at all? It has got equity of 10 lakhs and it has got, let's say, debt of 10 lakhs. In that case, it would again come out to be 20. But let's say, this is 20 and let's say this is 30. Okay, so then we will calculate a weighted average. We'll say that weight here is 40%, weight here is 60%, and then weighted average would come out to be 10 plus 9. It would be 19. Okay, so this 19 that we've got here, prima facie it appears to be back. But that's what we want to learn slowly, that how to calculate cost of debt. Okay, so let's start. Is this okay up to 19? Rashna? 19 is okay? Sure? Okay. Anuja? See, how much is your total capital? 20 plus 30? 50. So 30 by 50 is how much? Yeah, 0.6 is how much percent? 60%. So this is 60%. Then 20 by 50 should be how much? Come on, do you really need a calculator for this? 20 by 50 is 40%. Cost is how much? 25. So 25 into 40% is how much? 10. 15 into 60% is how much? 9. So weighted average cost of capital is how much? 19. Okay? Now let's start step by step. Let's start with first cost of debt. Okay. Now let me write two scenarios here. There are two companies, A and B. Okay, they are exactly in the same business. Both of them have total capital of 100. Okay, except that A is a pure equity company. It does not have any debt whatsoever, whereas B has got debt of 80 and it has got equity of 20. The cost of interest has been given as 12.5%. So how much would that be on 80? It would be 10, which means interest should be 10. Let's say that both of them make exactly same sales, 100. Same sales, 100. All other costs except the interest cost is also same, 50 and 50. Okay. Now if I stop here and if I ask you that interest cost for A would be 0, interest cost for B would be 10. What should be the difference between the two profits of A and B? It would be difference of 10. Correct? So it appears as if the profits of two companies should be different by 10. Let's build this further. This is now 50, this is 50. This is typically called as EBIT. Sales minus all operating cost. From your EBIT, let's reduce interest. 0. Interest is 10. What you get is EBT 50, EBT 40. Let's assume a tax rate of 30%. 15, 12. Let's find out final profit. Let's find out the difference between the two profits. It's 7, not 10. Tax shield. That when I paid interest of 10, I paid lesser taxes of 3. So it's like a discount given to you by income tax department, and therefore when you pay that interest amount to bank, you're saving some in the form of taxes, and therefore your effective cost has come out to be 10. So how did we get this effective cost has come out to be 7? How? I have paid extra 10 here, which you can see here, that extra 10 went out, but then I paid lesser 3 in the form of taxes, so my effective cost was 7. So when you calculate cost of debt, so in this case, had I told you that 12.5% is the cost, which is pre-tax cost, correct? So how is this derived? It's derived as 10 by 80, but actually it's only 7. So 7 by 80 is how much? 8.75%. You could have derived this 8.75 directly by multiplying 12.5 with 0.7. 12.5 into 0.7 would be 8.75. Is it correct? Yes. So how did we get 0.7? 1 minus 30%. Correct? So cost of interest into 1 minus 30%, 1 minus tax rate will give you effective cost of debt. And for calculation purpose, we have to use effective cost of debt. Are we clear with this logic here? So write down this example. You might also want to write down their capital structures. Firm A is an all equity firm with equity of 100. Firm B 80% debt, 20% equity. Sorry? Huh? Oh, it's a levered firm, yeah. Good. Correct. We have some one or two problem on leverages. If you're okay with this, we can move on. Have you written down everything? So also write down effective cost of debt formula. Effective cost of debt is equal to interest rate into 1 minus tax rate. Effective cost of debt is equal to interest rate into 1 minus tax rate. 1 minus tax is in bracket. Okay then, so cost of debt is done. Let's do next example. Cost of preference share. Cost of preference shares. Okay, so if the preference shares is given as perpetuity, okay, so let us say that there is a preference share which has got face value of 1000. Preference dividend is 12% and this is perpetual. Okay,
But whether preferences are redeemable or not redeemable, that depends upon perpetuity.
so which means these are non-redeemable.
Non-redeemable.
Yes, but of course non-redeemable we don't have them in India. We as per the company's law we are not allowed to issue non-redeemable preference shares. So this is preference dividend of 12%. Market value of preference share is 900. Calculate cost of preference share. So if you want to write down the formula, cost of preference share is equal to preference dividend divided by market price of preference share. So 120 divided by 900, that would be how much?
13.33.
13.33. And do we have to make tax adjustment for preference share? No. Are we good to move now? Have you followed the logic for this? It's a perpetuity. So cash flow divided by market price will give you discount rate. Cash flow divided by discount rate will give you market price, either ways. And the last one now, which is cost of equity. And by this time we've studied this various times, that there are three approaches to find out cost of equity. Three possible approaches for your CA final exams. The most popular is CAPM approach, where cost of equity is equal to RFR plus beta into market risk premium. The second approach would be dividend discount model, where cost of equity is equal to D1 divided by P0 plus G. And the third approach, since it's not visible, I'm writing here. Yes, bond yield plus risk premium. Okay, so YTM on a bond plus risk premium. YTM on a bond plus risk premium. Bond yield plus risk premium approach. Have we done? Okay then. So let's solve one case